Hello, everybody. My name is Daniel Young. I'm the owner and founder of Adapted Perspective and the Adapted Perspective social media platforms. And I am going to do something I have not done in a while, and that is to make a video while it's still light outside. Um, Oddly enough, I've hit all my chores for the day. I'm prepped for the week, so I'm starting early, which again hasn't happened in a while. So I've gone back through recent comments, looked back at and interacted with several people, um, and I have been working on a system update or a um, like a system review, I guess you could say, of everything I look at when I consider closed-end funds and how we invest. But that is not today. I want to continue uh, my norm, or I guess what has become my norm, doing a week review, a week's review, maybe not a week review, but a week's review of the financial markets, as well as offer you a perspective on the entire system of how what I'm going to talk about today, of how these kind of scattered random bullet points from different news groups or different uh, market reviewers are important, but at the same time, we need to see the bigger picture because that's going to better define how we invest, but invest in the current market, but also our outlook as we look forward. So um, let's get the disclaimers out of the way. So this is an unedited video. Who knows what you'll hear in the background as I film these in my house. I am not a financial advisor. I am a strategist and a financial strategist, and I don't speak like the herd. I like to hope that I speak like an average guy you would meet on the street. And I hate wishy-washiness. I hate gray area, and I hate. I don't even know how to explain it. I like a common sense approach to things. I don't like when you talk with people and it just feels like slimy and snake oil. I hate that. So I walk in limited company, and sometimes sometimes I walk alone, and you really have to get comfortable with making independent decisions and be comfortable going a separate way than the herd. And that's really hard to do, but you get better at it over time. So thank you to everybody who's responded to videos. Please continue to leave feedback, or if you have questions on the market, or if you want to grill me about our individual strategy. The more comments, the more shares, the more likes, the more it helps me get this message out and help other people. So back to what I was saying. So pending the show, and y'all know I don't like listening to the guys who just read the teleprompter. I don't like those shows. So as I read, I won't say seemingly random, but as I read these different articles through the Online Investor and through Ready News, the Contrarian Outlook, uh, the free stuff I get from Seeking Alpha, I read articles from Bigger Pockets and Morris Invest, and we'll say lots of different sources. Everybody, for the most part, everybody makes decent. Let's put it this way: everybody's got an opinion, and in the words of a well-respected former coach of mine, uh, everybody's got an opinion, and at the same time, opinions are like assholes. Everybody's got one, and sometimes they stink. So we're not going to agree with everybody, but that's the premise going into it. So we can kind of cast that aside. So if we can take everybody's opinion and not from a standpoint of being offended, right? But if we can read somebody's opinion and think about it, and if you think about the one opinion, like if you level it or if you create just a list of bullet points, you're reading all these different opinions. And you can't just look at it as a single bullet point on a list. You have to write everything down and then see if you can. You're not shaping a narrative to the bullet points. You're more like assimilating the bullet points and trying to see how that's shaping the overall narrative. It's the overall narrative that you probably aren't going to get in the news, but it's also the current overall healthy state of the economy or the health of the economy. And the other group I listen to or the other group I read articles on is the MXM News. It's the news group that Donald Trump Jr. worked with, or at least helped launch. Um, so every information source is bullet pointing data, and they're talking about the stock market and tariffs and the economy and everything else. And that's helpful, but we can't just stop at their specific bullet points. You have to, and that's somebody's alarm going off in the background. You have to assimilate the data, and you have to assimilate the data without all that other narrative. So, as for me, and I really wish somebody would turn off that alarm. As for me, I believe the market is in a transitory phase, and I hope to explain that, or at least I hope that I can decently prove that to you. Uh, and I'll start it with this completely not stock market related, but related to the market overall. So, my wife and I went to a car show this past weekend, and we took a car to a car show, and we met other car show enthusiasts, and we were talking to a gentleman about buying an older truck. I mean, he didn't mention a brand. We have a '67 Chevy, and we love it. Long story, different day. Uh, so we're talking with this gentleman about trucks, and he was like, "Love to pick your brain. What have you learned?" And we talked about paint, and we talked about rust, and we talked about this and that and the other. And I showed him on the edge of our truck. It was like the paint stuff like this, or this spot or that spot. And he was like, "Oh wow, I had no idea that was there." Like I'm looking at it, and this is at the same time I can't see it. I was like, "Well, it's two things. One, it's our truck, and we know it, and the other is we've gone through this. We'll say lots of times. I mean, we've looked at the paint of this truck a lot, but we've also looked at a lot of other cars. So we know of different things to look for. Like if you want to look around the edges of windows for rust, surface rust is easy to fix. Rust at the corner of windows or rust that gets into the trim of windows, that's a little harder. And we went through a list of things, but we also talked about the economy at large. If you look on Facebook Marketplace right now, there's a lot of cars for sale, and they come in a variety of conditions. And you can buy an old school Cadillac for $125,000, which that is not me. And I'm not buying a $400,000 luxury yacht on Facebook Marketplace. I we shop Facebook Marketplace for value and for deals. So in that range, we'll say sub 7,000, there's a lot of good deals on project based and not we didn't we don't want to take over somebody else's project. So we don't want to buy a $15,000 vehicle and take over someone else's project who probably had a much different vision than what we wanted. So we want sub 7,000, something that's in great condition, that has specific metrics, that was still a good deal, and then we can use it to, or say we can use it to take our vision forward. But that's the current Facebook Marketplace. Facebook Marketplace now is people, the herd mentality and the overall mentality of the economy overall is that the economy is not in a great shape because that's what you see on the news. So people are selling their toys. Now, you can argue that it's trash. One man's trash is another man's treasure. And there is trash. People sell trash on there for a god awful amount of money. Like pick your rusted out 60s antique car, completely rusted out, no motor. Some people still want 4 grand for it. That's trash. And it is not treasure. But somebody is selling it like a treasure chest, and it is not. But you right now you can find a really great deal on somebody's car, whether it be toy or a barn find or a relative or they didn't want it, really doesn't matter. Right now you can capitalize on somebody else's, I don't want to say misfortune, but their predicament. and you can capitalize on it and find a really great deal right now because as much as inflation is going down and as much as our economy is shifting in our favor, it still hasn't gotten to the point of everybody feeling it yet. You can see it and you can see the trend, but you're not really seeing it in your grocery bill and in your utilities and on your paycheck. So we talked about that. And I think, I still think, I believe the economy is in a transitory phase where we're waiting on those changes to really not manifest, but become evident in our daily lives. So it's a really great time to buy a classic car on Facebook Marketplace. It's a really great time to prepare and make sure your portfolio is great for the coming market. And really, it's not a fear of missing out. It's not a desperation move. It's not a it's not a feeling of we have to do this tomorrow. Our portfolio is well prepped for the coming phase, but it's almost like we're ready to do a portfolio focus shift or a target shift, but we're still able to make great deals in the current market. So if we take that overall big picture concept of the Facebook marketplace and we apply it to the stock market, okay, where does that leave us? So let's look at the overall bullet points. You have one, President Trump and Secretary Bessent are focused on the 10-year Treasury rate, and they hope to lower that rate by using four separate pressure points. So, of those four pressure points that I've talked about in at least the last month, I want to say at least the last 2 or 3 months, but there are four pressure points. Tariffs. Tariffs don't increase inflation, despite almost every legacy media partner telling you the opposite. Instead, tariffs bring people to the table. In our case, they bring people to the table to negotiate or renegotiate trade routes and trade interactions. So you got to remember, countries have successfully used tariffs to support their budgets for years. Tariffs were a great idea, an incentive for everybody until President Trump put the practice in motion for the United States. And that should tell you everything you need to know about the media and those teleprompter jockeys. If tariffs are a great idea for everybody and a horrible idea for the US, who do those people really support? So um, let's see. Pressure point two, deregulation. The goal is to gut the government and cut costs, lower consumer costs, lower cost of doing business, promotes more spending. It's a huge thing on the small business end of things, but it's really a huge thing for every level of the business environment. Pressure point three, promote the perception of a softened job market. Um, I don't, I don't quite know if we'll truly have a higher unemployment rate. Part of me would love that because that means we're really cutting and nixing excess government jobs, right? But we, in the deregulation of government and cutting red tape, and Doge's role in exposing the waste, fraud, and abuse, part of that's going to come through employee layoffs. Now, there were almost 10 million official government jobs. There were 428 some odd departments. That's a lot of people, and it took a lot of money to fund it all. Big government always wants more money, and it fights like hell to keep its power, which means it takes our money and takes our rights. Shrinking the government and cutting the red tape saves us all money and it gives us more power. It's returning the right of governance to the people, which is kind of strange that the media hates the idea. Now, unofficially, there's another 15-ish million government employees provided by third-party contractors. Lindsey Graham, who's a Republican in name only, has this famous line about sending money to Ukraine, that they would send taxpayer money to Ukraine. And by doing that, they would pay US contractors all of our taxpayer money, and that money would circulate back into the US. That's a farce. I mean, half the money to Ukraine can't be found, right? But that's a farce. It's like the worst version of trickle down economics I've ever heard, right? But just think of the scale. 25 million government employees. And that's on the short end of the estimate. You've got 25 million government employees voting for a larger government and voting against Doge and against you and me. I mean, if there's 150 million voting, 150 million voters, we'll say, which I think is a little high, but I mean, 25 of that, 25 million of those are government employees. That's just insane. Okay. Now the other pressure point, the fourth pressure point is drilling, or at least drilling for oil. We want to bring back the age of the Clampets and bring back drilling for Texas tea. That lowers the cost of oil across the board. We were buying the dirtiest oil in production from a foreign country with a dictatorial government, sending it across the oceans to get filtered somewhere else on a diesel. The whole metric of carbon is bad and oil is bad. So we're buying the dirtiest oil in production from a country in South America, carrying it across the ocean in a diesel ship somewhere in the Middle East to get filtered, and then carrying it back across the ocean to bring it to the United States. There's a ton of production cost in that. There's a ton of filter cost in that. There's a ton of transportation cost in that. All of that gets poured back into the consumer because somebody's got to pay for it. But if we start producing it at home, our country as a whole, pick your drilling base, makes cleaner oil, can harvest cleaner oil than what we were buying right at top dollar from somebody else. So now we're making it at home and shipping it across the country. That saves us money. And oil goes into everything. So if we lower the cost of oil, grant more drilling permits, allow more uh, quest, search, however you want to say that for oil, we thereby lower the cost of everything. So you add the four together, you add four pressure points together, and you have President Trump and Bessent focused on the 10-year Treasury rate. But I also think by doing such, they are indirectly forcing the Federal Reserve to lower rates. The Fed likes control, right? So if we're looking at bullet points, we talked about the four tariff pressure points, or the four pressure points, but the bullet points, you have Trump, or you have President Trump and Secretary Bessent focused on the 10-year Treasury. The second bullet point would be President Trump and Secretary Bessent indirectly forcing the Federal Reserve to lower rates. The Fed likes control, and they like their manipulative schemes. And if President Trump and Secretary Bessent are successful in the measure, I think Jay Powell keeps his Federal Reserve chair spot until the end of his term in 26. I think if the effort is unsuccessful, they will work to force Jay Powell out, and they'll further expose just how shady the Federal Reserve has been. Now, the Fed's dual mandate, or their self-described dual mandate, is to lower inflation to below 2% levels and control rates to control inflation. But what happens when the Fed doesn't do its job or manipulates the system to ensure its job? See that the inflation we're dealing with, the Federal Reserve caused. They printed 40% of currency in like 4 months. I mean, they printed $3 to $4 trillion in paper money. It's the easiest way to devalue money is just to print more of it. So the Fed caused that spike in inflation, and now they're trying to fix it. Yeah, they caused the problem, and somehow they get to keep their job and fix the problem. And they have been intentionally slow rolling rates. And pick your economic advisor, almost everybody will tell you the Federal Reserve is behind the curve the entire time. Why? Because they keep power and leverage. It's And why I rate these videos as not for kids. Uh, if you think of the Federal Reserve and how they've been behind the curve and behind the rates and waiting to slash all of that stuff, if you think of that, it's very much a fuck you to the American people. But that's Jay Powell's Fed. And I don't like it, neither should you, but that's our current Fed. And the reason why it's super important right now is Secretary Bessent has to refinance 9 trillion in debt this year. You really can't effectively refinance the debt at a higher rate, right? Because you'll still just be paying out more money. So a 7% interest rate on the short end. So the 10-year curve we want lower, but we also want to influence the short-term rate. Current short-term rate's like 6.8, almost 7%, when inflation's supposed to be 2%. So you really can't refinance 9 trillion for 7%. I mean, you can do it, but it's not going to be effective money savings adventure, right? But if you can budge the Fed and force them to lower rates, then you can refinance at a better rate. So why would the Fed cut rates? Well, if inflation is at 2% or lower, the Fed should cut rates. That's their criteria. Okay. The other reason they might cut rates is a perceived recession or a slowing of the economy. It used to be a recession. Currently, it might be a slowing of the economy, depending on who you read. They would cut rates if there was a softer, more populated, higher unemployment rate. And if you remember what Trump and Bessent are doing, they're kind of forcing that to happen, or at least forcing the perception of part of that to happen. Since President Trump and Vance and Vice President Vance took office, inflation has gone down every month. But now there's the fear, or at least the perception, and a rising fear of a recession. Okay, so on that, bullet point 3, government spending has dropped 5% in the first quarter. They took office in January. 3.5 months later, and maybe it's 4 months later, depending on how you want to do the math, government spending has dropped 5%. That's crazy. Okay, Doge and department heads are cutting spending. We want that. The government spending influences inflation just as the Fed does by printing more money. So we have the Fed not printing more money, and we have the government not spending more money, and inflation drops. Go figure. So, kind of ad libbing my notes as I go, right? So, if we look in the past, inflation was high because the Fed was printing money. They were quantitative easing, they were printing money and slipping money into the market. And you had the government spending more and more and more in sending aid here and there and anywhere but America. And now that all of that's been stopped, the USAID budget has been cut by, like 80% down to 20%. Department heads aren't spending. America itself is not spending as much. 5% doesn't sound like a lot, but it adds up when you're talking about trillions of dollars. So based on that stuff of what's been cut so far, there's a growing sentiment or growing fear that we'll see a worldwide recession. But the question you should be asking, and the question that no one in the media wants to ask, is this: just how much money was the USA shipping around the world? If cutting the USAID, if cutting those initiatives and cutting wasteful, abusive, and excessive government spending, and if stopping the Fed from just printing more money and more money and more money, if all of that together causes a worldwide recession, then the US was printing a shitload of money and offshoring that taxpayer money, or having it get lost on the way to offshoring. They were shipping it everywhere but American infrastructure and our pockets. That system is not maintainable. It's not functional. Scott Bessent stopped borrowing just to put more money on the American taxpayer to pay back, right? That system leads to bankruptcy and default. Who would profit? China. So do you understand what we're seeing on a global scale? You understand the tariff game now. Every country has come to the table to renegotiate with China. We're watching a toe-to-toe heavyweight boxing match between the current worldwide economic business leader in China. And every other country bailed on China. They renegotiated trade deals and went with Trump for a reason. By going toe to toe with China on trade and by holding the line, which most countries are not used to American presidents holding a line. Pick a president before President Trump, Republican, Democrat, very few independent, but Republican, Democrat. There have been very few presidents who will say, "Here's the line, don't cross it." Right? They're not used to that. So by going toe to toe with China on trade and holding the line, when every simping, sycophantic media shill and every stock market supposed expert this week and teleprompter jockey is pushing fear over this and that and the other, and the US is actually taking on China. And sadly, the people in our own monetary system who want us all to fail. Like, it's crazy. What did we learn at the end of last week? China's economy is feeling the heat from tariffs. They're starting to relent tariffs on the US. They're trying to play quid pro quo, and that it's like, if you do this, then we'll do that. And that's not the game, right? They're starting to crack. And when President Trump wins that tariff game, because he's going to win that tariff game, the global system breaks and America is back in the front and back and leading. And the reason why President Trump will win is that he is, regardless of party system, he's probably the greatest negotiator of his generation. For certain, the greatest political or other negotiator I've seen in my generation. Okay, he can get people to the table to talk. Now, they might not like anything they hear, but he can get people to the table and he can hold people to a deal. It's his book, The Art of the Deal, but it's also that Sun Tzu battle. Oh, what is it? The Art of War. There we go. It's how you deal with people, and it's also leadership. And I'll say this, and then I'll move back to the economy. When you go to a meeting, we'll say, and it's led by anybody, right? Not like when you're at the meeting as a participant, but not leading the meeting. The president of the group opens the meeting, and on, we'll say, meeting wise, they conduct business according to an agenda. As you go through the agenda, the president acts as a figurehead, but they're actually conducting the meeting. But when it comes to stickier discussions and opinions, the presidents who micromanage and really don't want your opinion will talk the entire time and never ask for your opinion. In my experience, if I'm trusting a committee chair to do a job, then whatever opinion I have, whatever way I want the decision to go, whatever way I think that needs to change, I'm handling all of that before the meeting so that at the meeting, we're listening to the committee chair and I already know how things are going to go. Like, it's not a surprise. But also, in addition to that, you're asking, so it's like, I want this to happen, but I'm not going to come out and say it. You want the committee chair who runs the committee to make the issues known. But you also want to open it up to, like, the big stuff. You want to open it up to the group at large, and you essentially let everybody else talk, and then you talk at the end. And now you've given everybody a voice and an active role to play, in addition to your committee chair or your department chair or your cabinet chair or your secretary's chair, right? And you're letting all of that happen, and then you're talking at the end. You're either summing things up or you're agreeing, or maybe you go a different way. But by talking at the end, you allow everybody else to go, and it looks like you care about what they have to say. Now, maybe you don't care what they have to say, but perception is everything, right? Trump actually cares what people say. JD Vance has an interesting snippet on President Trump's leadership and how very different it was to everything else Vance has experienced in Washington. I mean, he was kind of like pick your regional issue. Trump could very much say, I think this, but instead he'll go out and he'll talk to people, call people on the phone. He will go meet with people in person. He will talk with all of these different people about issues and form an opinion and then tell somebody about it later, which is why President Trump negotiates well. It's start from a very rigid standpoint, right? Like I want this to happen, but I'm gonna start on this crazy rigid standpoint. And when I bring people to the table and we start to negotiate, and when I concede and we make concessions during negotiations, like equal and fair concessions, that when we end up where we want to end up, it's where I wanted to end up all along. So it looks like I gave things away, but I really didn't. He brings people to the table, and now we have tariffs working for the American people. That's an amazingly good thing. We have this figurehead leading us in that battle. Now, I say all of this, right, to kind of give you the background and the shape of things or the scope of things. We are in a transitory phase of the economy. We are onboarding American manufacturing, meaning more money, more development is coming into the United States, as along with more jobs and more better paying jobs. We have lowering inflation, which means a better cost of living. We have lower oil prices. That means lower cost of production, lower cost of transportation, lower cost of maintenance, lower cost for everybody, lower cost for you and me. And with tariffs handling the bulk of the US budget, that means that less of that budget is being supplied or sourced through taxpayers. Now, the current talk is to go no taxes on people making $200,000 or less a year, right? And that's up from the previous discussion of making it $150,000 or less a year. That's how much money we're bringing in on tariffs. And that scares people because you're taking power away from certain areas inside our government and certain power groups inside our government. So that while the media freaks out about tariffs, which I mean, let's be honest, they're just reading somebody else's opinion. But even my trusted sources are floating this idea of a coming or like a coming season or a rising of inflation from government spending. Now we've cut 5% government spending. I think we're going to cut more. There's so much of the government budget that's mandatory that's just really hard to touch. But you have to see bigger picture. So Congress supposedly writes laws and deals with the budget. The Congressional Budget Office evaluates the budget and is supposed to realistically say if it can happen or not. So if they spend more than what we have, the CBO says, hey, you've overspent. You either have to cut or add more taxes. Right. And we all know our Congress hates cutting spending, which is why Doge is so important. So they can be like, look at all the shit we're paying for and all the stuff we don't need. But it's really up to Congress to cut spending. And Doge's um, can't think of the word. Doge's mandate was to cut 2 trillion in spending in the first 2 years of the Trump Vance ticket. Congress overspent the budget by $2 trillion. Shouldn't be possible unless you're planning to tax the American people more. So now Doge's mandate is to cut the budget, to cut spending by 2 trillion in the first 2 years. So now at least we have a balanced budget, but you also have Trump and Vance pushing Congress to create a balanced budget and allow tariffs to pay off the deficit. right? And our expanding debt, $36 trillion in total debt. Nine of it has to get refinanced this year so we can save some money. That's a shit ton of debt. Like that debt alone is crazy. Congress overspending is crazy. Doge coming in to audit the government and cut 2 trillion in spending and try to force Congress into actually saving money. All of that's important and it's all working at the same time. So we've still got my trusted source saying this Trump Vance ticket is going to be inflationary in the sense that they're going to have to spend things. I disagree. Trump and Vance want to they do want to spend stuff to like say on the military, on the stuff that we have to, but that's already factored into the budget. They actually want a deflationary course of action. They want to spend less. They want to cut spending. They want to offload risk from the government payroll. Yeah, I don't buy this idea of a coming inflationary cycle. I just don't. So I think we're in this transitory economy where we're still dealing with all of this, right? And you've got the media and freaked out. That's the media. But we have all of this that's happened, and we have all of this that's coming and hasn't happened yet. And I think we're in that trough about to rise from the ashes. I can read the promises, I can hear the stuff, but I can also see that glimmer in the horizon. I mean, the shrinking inflation is huge, right? Forcing the Fed to cut short term rates is huge. So, where does that leave us? I mean, what would profit the most from a rate cut? Fuck everything, right? Everything would do better with a rate cut. Everybody's everybody. I mean, across the board, the media is going to react how the media is going to react. Everybody across the board, it's like it's an emotional high. Like everybody is interested when the rate cuts happen. That's a good thing for the economy. That's a good thing for sentiment. That's a good thing for confidence. That's a good thing. Okay, so what's the best course of action? Where would we see the best gains? You have to remember the herd. And the herd just watched growth stocks tank because their teleprompter gurus freaked out on tariffs. And comment all you want. Uh, Here's the deal: if those teleprompter, yeah, teleprompter jockey is about the best nickname because anything else is just too blasé or uncouth. But the if those teleprompter jockeys cannot define a woman or a man, they're not going to understand tariffs. And if they're an expert on student loans this week and tariffs the next and economy policy the next and the new Olympic sports models the next, can they really be trusted on anything? No, but the herd hears all of those people and they pay attention to those people. Okay, the herd is the herd for a reason. You and I are different. Okay, the herd follows the crowd. We don't. We pay attention to where the crowd is, but we're not following that, right? Follow the herd, you step in their own shit, right? So the herd hears and feels that panic and they respond and they sold out and they're looking for dividends. They're chasing dividends at this point, right? They wanted growth. Buy Apple. So in 5 years, you get 10% growth. They wanted growth, even though Apple pays shit for dividends, right? They sold that and now they're looking for dividends and they'll find those dividends in bonds. Right? So that means we'll see the best gains in bonds for two reasons. One, it's the best deal in the market. It's great discount. I mean, it's a great discount territory buy. But also, when the Fed cuts rates, because they're going to have to cut rates, when the Fed cuts rates, that herd will come charging in and they will Well, I won't say they'll solve everything, but they're going to shrink our discounts and escalate that price higher, right? So that means we'll see the best gains in bonds and bonds proxies, especially since we've been into those things since they've been super cheap. I mean, we've been into bonds for like the last 3 years, 4 years in some cases, right? We've bought bonds and corporate bonds and municipal bonds and BDCs, business development loans, and real estate and utilities for a while. I mean, the herd is on the move. They've started a migration from growth into dividends. They're just not there yet. It's like watching geese migrate over the winter. I mean, geese come in from Canada. It takes a while to fly from Canada to Texas, right? The herd has started that migratory pattern, but they're not going to migrate as much now as when rates drop because the herd is always late to the party. And we want them to be late to the party, right? We can make a lot of moves while they're not here. We can still make moves while some of them are here. But when the herd arrives, you want to be set, right? Because that greed cycle kicks in and it gets harder to find a discount. You can still buy. I mean, that CNN Fear and Greed Index is a pendulum of overall market sentiment. It's not specified to individual sectors. You could probably still find a bond account or a bond fund on discount meeting the metrics during greed cycle. It's just going to be harder than what it is now, right? So with the herd showing up late, we want to buy bonds and proxies now and let the herd lift those prices and close the discounts later. And when rates finally drop and when the herd shifts into bonds, then we look elsewhere. And it's tempting to look now. I mean, it really is. It's tempting to look specifically into tech um, and consumer funds now, although I'm not a huge outright consumer funds guy because the consumer market space, regardless of economy, is still just so volatile to me. Like outright consumer, Mondelez that owns Oreo, Heinz, Kraft, cars, truck. I mean, it's so volatile to me. So unless an amazing deal presents itself, like if we have another tech dip or a hiccup, that probably a great time to buy tech. My favorite tech fund is about 9% under its top value of what it used to be. So it's still a pretty good pickup. But like we had ChatGPT, Grok, OpenAI, uh, plus whatever hiccup we saw out of China where they illegally bought those microchips and made their own chatbot or their own ChatGPT bot for cheaper than ChatGPT. Like we're going to see that more often as countries vie for positions of trade prominence. We're going to see that. And as AI continues to expand, we're going to see that. So it's tempting to buy technology, like outright buy technology. But with it's two parts. One, bonds and bond proxies still seem like the best way to target the market. And two, there's rumor or at least some theory of us having some type of additional technological dip or technology based dip in the market because of how much competition is coming online at the same time. Now, it's two things. You cannot buy with the mentality of, let's say, fear of missing out. Like you don't want to be forced to buy. It's also the same thing on the opposite end of things. You don't want to buy in that, like, are you, regardless of, I don't want to say they're random, regardless of these people's wonderings and mutterings about a possible uh, tech dip in the technology market, maybe it never happens. right? So now it's like fear of a portfolio devaluating versus fear of missing out on greed. Fear of missing out on greed or fear of missing out on weakness. I don't know how to make that second one honestly sound as good as the fear of missing outside of things, but you're going to have to find your own sweet spot. Um, I can make a case for buying NBXG right now based on discount and price, but I still don't think it's the best place to be overall because when rates drop, the herd will show up late to the bond market. Now, the market itself, yes, should take off. Rates drop, people think they have more to spend, they'll invest into the market anyway. But the more AI competition we have, it makes sense. This is both listening to all of those other articles, but also thinking for myself. It makes sense that we'll see some other type of technology based blip in the market. If it happens, I have no idea. That's the market. You roll the dice. But when it comes to investment, the best place to invest right now still seems to be bonds and bonds proxies. So, without further ado, let's jump into this list for the week. And let me share my screen. So, slightly different look for the master list for the week. And I'm going to try to continue this. I really tried to thin it out to be less confusing. So, I have the cash brokerage funds, I have the Roth funds. So, you can see what we own in both, but also see how they're different. Still tracking the trusted source recommendation as purple. Everything else, even the funds we own, get tracked in green. Um, I went through this weekend and updated everything. Uh, April ended, May started. It's my daughter's favorite Star Wars day, May the 4th. Um, so I did go through and update everything. And yeah, new look, different month. We'll try it out. So this is where we start on this filtering process. Um, and I guess before I get to that, I had somebody ask me if I could make individual portfolio videos um, to where I would review what we have in each portfolio, I guess current holdings, current plans, overall strategy. That kind of gets into that other video that I do want to make. But I at least want to show this. I mean, this is accurate as of me doing. Let's see. This one is not completely accurate. I got to update the dividends because I haven't filled in the dividends for April, but I have filled in the dividends on the Fidelity end of things. Full system update takes a while. I have updated the dividends on the Fidelity end of things. So these are the current overall portfolio values. Oops. For our portfolio, and why this is here is this used to be our dividend schedule for money managed with our former broker, or I guess our former account broker. He had this much total money invested. We were earning this much in dividends, hoping on growth, and overall just getting slaughtered on inflation. So what I hope to cover in depth in my strategy video for closed-end funds is why we opted for closed-end funds and why we like them better than single stocks. So this week's fund selection. So what we can filter out. There's only one quarterly payer on here. I mean, the push still is monthly dividend unless there's a good reason to buy something else. Um, and to be honest, if we're going to add a fund that we don't have, it's got to offer us something that we don't already have. Buying more of something just to be diversified in what we already have is just wasted money from my standpoint. So we want to prioritize these things. We want bonds, loans, and BDCs, right? Corporate bonds and fixed income, utilities and energy transfer, and real estate. And as tempting as consumer funds are, just not my focus right now. DOY is a sister fund of a fund we already own. Like DOY is the sister fund of DSL. We already own DSL. DLY, for whatever reason, has always been more expensive. It's not going to make the cut. Um, I've tried to add more notes as I go through things. So I will try to display these as I go. Hicks is on the list based on discount, but it doesn't really outpace the market. We own a Cohen and Steers fund as it is. I looked at this the other day and went to Morningstar and I pulled up the RLTY portfolio, the RQI portfolio, and the I can't remember what. Let's see, RFI. There we go. RFI, RQI, RLTY, all Cohen and Steers. I pulled up each portfolio and put them side by side and looked at their Morningstar valuations. And it's like the same exact portfolio. There's a little difference on one of them, and I forget which one it is. But it's really hard to buy another Cohen and Steers fund that does pretty much the same thing we already do. The only reason it would be considered is that, I mean, the RFI one is in premium. If we really wanted Cohen and Steers in discount, we could pick it up. But that being said, it's also valued on the higher end of things. And I tend to stay away from the $15 mark unless I have a really good reason to buy a $15 mark. I mean, my threshold for the general fund, or say the general list of things, is the gray area that you really don't see at the top because it's not supposed to be at the top, is I'm sorting out the yields that are less than 6 and I'm sorting out the funds that are more than 16. So to buy a fund above 15, I don't know if we have a fund above. Let's see. Yeah, highest fund we own is $12. It's really hard to justify buying a $15 fund on my end of things. River North, we've already got a bond. Pull this back up. We've already got bond funds and corporate bond funds and BDC funds and municipal bond funds. We really don't need to add another one. Yeah. WDI is the diversified portfolio in debt, but um, all right. So these two at the bottom are municipal funds. They're not triple asterisk in the sense of historic discounts, but they are dollar cost average based on the current value of those funds for our portfolio. DNP is one of the exceptions to the triple asterisk rule. Let's see. Get this all in one so you can pause it and read it. Right. So +4 is better than +8, but it's still not as low as it's been. FSCO has escalated in price. It's still a discount, but I think it'll go back up to premium. CIF is the other end of things. Indio, municipal bonds, consumer, more municipal bonds, bonds, consumer, bonds, utility. I'm not an Allspring fan. Um, yeah, I'm just not an Allspring fan. It's on the list because I'm trying to be truthful and transparent on the discount, but it's not going to make my list. TEEF, I cannot. It doesn't make sense to me. It makes sense to a younger generation, but it doesn't make sense to me. TEEF is invested into everything that requires oil to work and yet hates oil. So now we're back to a list of everything we already have. But can we further screen it? So I would prioritize a dollar cost averaged approach of what we already own. So I mean, we yes, we own everything on here, but how would I thin it out? And to be forthcoming, we're not going to buy tomorrow. But if I would buy tomorrow, if we bought tomorrow, I would I would take it with a dollar cost averaged approach to everything we currently own that fits the metrics of bonds and bonds proxies. This fund has done well, but I'm not a huge fan of it anymore. It's become a growing PIAC. It's a portfolio in a can. Instead of targeting what they were excellent at, bonds, real estate, utilities, energy, they've added more crap to the portfolio. And I'm not a huge fan of that. So what I've got to weigh long term is should we keep the fund? I mean, because it does pay a nice dividend, essentially getting 1% yield a month. Or when this hits 20%, I mean, in theory, whatever this averages to, I mean, if we hit 20% growth, do we just take our profit and roll the money forward into something else? Or do we wait and see what happens? But it's not, I mean, for sure it's higher than what we bought it at. I just don't know what to do with the fund long term. NBXG is my favorite tech fund, but we're prioritizing bonds and bond proxies. Maggie, it's that it doesn't meet the dollar cost. And I hope I'm not making you dizzy with going back and forth. So it sits above our current average price of share. Let's see, HFRO 523, that fits the metric. BRW, that fits the metric. CIF is not in Fidelity, it's in the Roth. In 73, it would sit below the metric. FSCO is above the metric. FSCO in Fidelity, right at 705, is above that. And in the Roth, yep, still above that. It's a great fund, but does not meet the metric for the week. And I get it. Like on a grand scheme of things, you're buying, pick a fund at different price points, right? And sometimes you're going to buy it higher than what you have. Sometimes you're going to buy it lower than what you have. So if you just love the idea, and I mean, I love the idea of the fund. I would buy FSCO over CIF, even though it would cost you more per share. It's a bigger company that has that private lender BDC component that I think is great for the current and the coming economy. Um, so would I go against my own metrics yeah, I could do that. I would make an exception. DNP at 960 is above the current metric, and these are already dollar cost averaged. So if we were buying in the Roth, these two funds don't matter. Um, in the sense that they pay tax-free dividend equivalents. That's great in a cash account, but in a Roth, it's already tax-free. It doesn't really make sense to me to do it. So if we were going straight Roth, I would pick the top four. If we were going cash account, we're not invested in this one fund. So I would withhold that off the purchase list. But if we were going into the cash account, we would buy five of the six listed. They're all outside of FSCO, they're all great dollar cost average pickups. And the FSCO end of things, it's a fund that I think will hit premium and then go beyond it. My overall, I mean, the possibility of things is it really becomes like a PIMCO or a double line fund where it exists above neutral. So I mean, if we go with discount, neutral, and premium, it exists in premium a lot of the time, and then every time it dips into discount, it becomes a worthwhile buy. So at a 2% discount, it's not that big of a discount compared to what it used to be, but it's close. I mean, last on the dip, we bought the dip. In the yellow boxes, I mean, we've been paid the dividend, but at the same time, the ex-div date hasn't been posted. And I like the accurate ex-dividend date, so they're still yellow. So it's kind of in long. It's that 2% discount is kind of in line with where it's been. Uh, it's not the highest purchase price we've bought. I mean, I can argue for it. I can argue against it. Really, it's really going to come down to you, whether what you like and what you don't like. But for me, for the week, I would prioritize the dollar cost average approach if I was going to buy anything, and we're not buying anything this week. Um, I'm just not. Just um, we bought early. We were buying end of month, and then I believe we bought. Yeah, it would have been this week to buy, and it buying stocks is the or say investing in the market, however you want to say it. It's the mentality of things. It's got to be. Can't approach it with a fear of missing out. Can't approach it in the sense of like I'm going to buy even though it doesn't feel like the right thing to do. If it doesn't feel like the right thing to do, it, and Simon Sinek talks about this in his leadership speeches, the feeling of something not being right exists in a part of our brain that like we can't put it into words. It just doesn't feel like the right thing to do. Those are generally good times to pay attention to what your body's trying to tell you, and it's not for whatever reason, it's not quite lining up with things. Even though you can't express it, you should pay attention to that. And I don't have a reason. Well, I have two reasons for not buying this week. One, uh, I really do need to make an updated strategy video and take both the advice and the feedback from y'all. I need to make an updated video on strategy and do that. I need to. Um, I need to not so much rethink our strategy, but I need to almost dwell a little bit on the coming market and see where we would go. Um, Kind of like that. It's not here yet. It's all going to be dependent on what happens. But when rates cut and when the herd shifts into bonds, the options will be to hang out and see how things play, or it'll be to find another dog corner of the market and invest where people are not. And you can argue for both. I mean, I like action over sitting, but we'll see. And that's kind of what I want to wrap my head around. We have a little more money to invest. And I mean, I can make a case for investing in this. I mean, if the market stayed the same for another month, I could make a case for investing in this or into this, 5 spot or 6 spot, depending on how you look at it. Uh, but after a busy week and at the end of the school year when things are crazy, I don't want to rush our investment. Um, I would like the Fed to cut rates before summer. I would love them to cut rates by Memorial Day, right? I would love them to cut rates before summer, right? Because I think that would do wonders for the real estate market and amazing for people around the country who are moving, right? Whether retiring or really as the school year ends and people really move. I mean, that's the real estate cycle of things. So I would love to see the rate cuts before the summer because I think that would spark our economy. But I don't know if it'll happen. The Fed likes the limelight. So would you rather cut rates going into summer? Because I mean, that would help people. Or would you rather cut rates at the end of summer when more people are going to pay attention? But if inflation continues to fall down, and if the job market continues to be a little soft, if oil continues to slip, right? All of those things come into place. It's going to be harder and harder on the Fed to ignore it. So we'll see what happens. It's not a movie, but it's a very great chessboard. And it's just positioning ourselves in the best way possible for what we know will eventually happen. Fed will cut rates, they'll have to. So it's doing the best thing we can in light of that, but also looking at our strategy beyond that. Because I mean, again, the market continues, regardless of how the market is, regardless of how you view the market and the economy, they both move forward like a stumbling toddler looking for the next shiny toy. So when the Fed cuts rates, I'd much rather know where I want to go than waiting. Like I want the plausibility thing. Like I want these options now so I can know what better to look for than being rushed into it later or pausing later. And not so much the fear of missing out, but having losing the ability to know where I want to go when it needs to be done and playing catch up. I don't want that. So I need time for strategy, and time has been a lacking commodity on my schedule that I'm hoping to see more of in the near future. So I hope the video has been helpful. Hope it's been beneficial. And again, if you have comments, questions, specific fun questions, if you want to talk strategy, bigger picture, smaller picture, bullet point, whatever you want to do, just drop me a comment. And then if you like my content, please consider subscribing to my channel, like the videos, yes, drop a comment, but then also share the videos and help continue to get the message out about closed-end funds. So yeah, I think that's about all I got. So whatever you have for the week, I really do. I hope it goes well for you. And if you've got a big decision coming up, my advice about everything, if you've got a big decision coming up, pray about it, think about it, and don't do it last minute. So have a great week, everybody, and I will see y'all on another video. And hopefully God, the strategy video. It's hard, quite honestly, it's hard enough to make an hour plus or even like a 30-minute video every week just with a schedule. Got to add a considerably longer video on strategy and everything else. So I will work out a good day, or maybe I'll just double post next weekend. We'll see. But I will work on um, finalizing my thoughts, and then I will work on producing that video. So whatever you have for the week, I hope it goes well. And at some point, I will see y'all on another video. Have a great week, everybody. Bye bye.